Good evening, everyone. Welcome to our Giraffe podcast. Today, we will be deep diving into the world of fixed income investments and we will understand the bond market in India and how Giraffe as a platform is helping people access the same. I have with me my co-founder Saurav Ghosh. He will start the discussion and he'll explain how the bond market in India is, what are the nuances of bond market, and why that is a good investment product for individual investors. And then I will be talking about how Giraffe brings this unique opportunity for investment to the individual investor.
Thank you, Vineet. Hello everyone. First, I would like to cover, what role a bond plays in a financial portfolio, and how should we look at fixed income and bonds as an asset class, right? So, if you see the first slide and the top left of it, these are the various asset classes that we typically hear about as an individual investor. The ones in black, this is a risk reward spectrum or risk yield spectrum. So on the y-axis is yield and return, and on the x-axis is risk. So if you see on the bottom bottommost left point of that, which is FD, fixed deposits and savings, that is your lowest risk product, as well as giving the lowest return. And at the top end of that spectrum is your angel investing, crypto, exotic investment products, which are typically highest risk and also will give you hence higher returns, at least optically, right? In between, there are multiple asset classes. So public market equities is somewhere in between, which is investing in your listed stock markets. And then below that, which is lower in risk than your public equities or equity investing, and lower in return as well, is where your typically bonds lie. Now, bonds cover a wide spectrum. So what we are essentially saying is that bonds fall in that category between listed equities and fixed deposits or your savings account savings, right? So you should think about bonds and fixed income somewhere in between. So the way to think about it, it is higher risk than FDs, lower risk than public equities, but will give you higher returns than FDs, and over a period of time and on post-tax basis, lower return than public equities today, right? So that's the way to think of, I would say, bonds and fixed income and the category that we are talking about. Traditionally, India has been saving, we know, a lot of money in fixed deposits. And after that, mostly beyond fixed deposits, a lot of money goes into your physical assets, which are gold and real estate. Now, beyond fixed deposits, gold and real estate, public equities, we have seen in the last 10 years that how it has grown in India. We feel that the next decade of growth will come from bonds and fixed income. And the reason is that, the kind of digitization and technology adoption that equity markets saw in the last decade, the similar disruption through technology is happening in the fixed income and bond space. And the coming decade will see the benefits of that. And here we are discussing about, beyond the ease of access that today technology provides, why should bonds and fixed income be a part of your portfolio? So going forward, if you just look at the overall market, and which is the bond market, India today, bond market is about 200 lakh crore, right? Which is humongous in number, because we don't hear about anyone actually investing in bonds or fixed income in our, I would say, social circle. But the bond market is big. Now, why it is big is because if you see the chart on the bottom right, right, or majority of the market, which is actually 78% is government bonds, 22% is corporate bonds. Majority of the market is basically participated by institutions. So all your large institutions, including mutual funds, large banks, and then there are a lot of, I would say, PMS funds, HNIs, family offices, which have very large exposure to this segment. They are participating in this asset class traditionally. So over the last 10, 15 years, institutions, banks, mutual funds, HNIs, family offices, all have been investing in bonds and fixed income. This is a category which is still new to retail individual investors like you and I. This is something that as Jiraaf, we are trying to focus on to create awareness as to why bonds is such a big part of everyone's portfolio here in India. It is also one of the largest asset classes globally. Globally, fixed income and debt markets are larger than equity markets in most matured economies. Now, this is changing in India as well. Over the last 5 years, bonds have actually doubled and participation in bonds have doubled. and we are seeing that change in in India as well. And we believe that next decade will be the decade of bonds and fixed income. And that's why we are here to explain what this is all about. So going on further to explain in very simple terms, what are bonds? So bond is a simple promise to pay. What we mean by that is, before we get into this, everyone understands fixed deposits as well. Fixed deposits also is a kind of, it works in the same manner as a bond or a fixed income product, which is basically fixed income. A bond is assuring you a fixed return over a fixed period of time. Now, beyond that, if you see this slide, what happens is on the right, we have a government, a company, or a issuer. All of these are corporates or organizations that are trying to raise money or borrow capital. Now, they can borrow capital from individual investors or what we call as capital market by issuing bonds. So what happens is that these companies, corporate organizations, government, public or private, they will issue bonds, and the investors, which you see this group on the left, in return invest, in these companies. So it is a fixed income product. That means these bonds will be of a fixed tenure with a fixed return. So for example, you will find a government bond or a company, let's say SBI. So SBI will be borrowing, for example, money at, let's say, 8% from individual investors. So what they will do, the SBI will issue a, let's say, a 3-year bond at 8%, and as individual investors, you can participate. What that means is that SBI will give you principal plus 8% return over a 3-year period, and this will come in a periodic manner. So you will know that this interest or principal will come to you monthly, quarterly, or annually. This will be known to you at the time of participation itself, right? So this will give a lot of clarity on when I can expect my money, and that is why we say that these are fixed income instruments. That means that I know that I will get this fixed return, and I also know that I will get it over a fixed period of time, which is 3 years. Now, this is very similar and exactly similar to fixed deposits. So in a fixed deposits, you create a fixed deposit with a bank. And what that happens is that the bank is borrowing money from you. And when you create a fixed deposit, let's say for 1 year, that means the bank is borrowing money from you for 1 year and is giving you 7 or 8% in return, right? So bonds work exactly in the same manner as fixed deposits. We all understand FDs. You can just extrapolate that to bonds to say that either instead of a bank that the government is borrowing or a company is borrowing, which can be public or private, right? So that's the only difference. Otherwise, it works in the exactly same. So why should someone invest in bonds, right? And the first and foremost reason is steady income, right? As I mentioned that when you invest in bonds or fixed income, you know that you are going to get a particular amount of interest or return and over a fixed period of time. So you will know today that if I invest in a 1-year bond, I will get my money back in 1 year, and I might get it in 4 parts, which is quarterly. So there is exact certainty that after end of every quarter, I will get 25%, let's say, of my capital plus interest back. Now, once there is such kind of predictability and certainty to your cash flow, after your investment, you can plan your finances very well. So for example, you can think that I have a vacation which I want to plan for a year down the line. I have some other spend that I want to do. So if I invest in a product today, which is of 1 year, after 1 year, I will get all my capital with interest back, and I can then use it for, let's say, whatever expense requirement that I have. In some cases, for example, if you have an EMI, you can also invest in a bond which gives you monthly payout of interest and principal. So every month you get your cash flow from a bond, and you can pay your EMI or service your EMI through those cash flows, right? So the kind of predictability that a bond offers, it helps you plan your finances and cash flows very well. This, I would say, value add no other financial asset class gives you, right? So for example, if you invest the same money in your equity markets, you have to invest with a 5-year, 10-year view, because you won't know that within 1 month, 1 year, how the markets will perform, whether I can get back my money with a profit, or I will have to take some loss if the markets are not doing well, right? So this kind of predictability, certainty, and steady income is the most powerful, I would say, value add that bond and fixed income provide. And hence, we really suggest to every investor, like all HNIs, family offices, institutions do, you should have a particular percentage of your portfolio in this category. The second is, I would say, why we why we invest in even real estate, gold, and equity. We always like or love one asset class, but we still invest across everything because diversification is very, very important. So similarly, bonds gives a very, I would say, gives a lot of stability to your portfolio. So you know that, let's say I have some part of your money in equities, some part in real estate, and some part in fixed income. So the equity portfolio is very volatile. You will see ups and downs in the portfolio. The real estate portfolio is very illiquid because you know that, maybe once in my lifetime, twice in my lifetime, I'll be able to, sell or turn around a real estate asset. So typically it is for buy, hold for the long term. So the third product, what bonds gives you, it gives you that bit of return, as well as it's giving that stability where I know that, I don't need to think about liquidity because I know my money will come back in so and so time period. So, right, so it has its own place in diversification. So, along with all other asset classes, this should also be a part of your portfolio. Third is accessibility. Most of the reason why people didn't have bonds in the portfolio is because of the lack of access. Now that is changing. Now today you can easily come participate through digital platforms in these asset classes. You, post investment, you will also have complete transparency and all the information and data that you require about monitoring your investment. So when that money will come back, how will I file my income taxes, and TDS that shows in my during my income tax filing, etc. So all of that data and information is very readily and easily available, and participation is click of a button through a digital platform. So in addition to certainty, diversification, now that it has become accessible, the kind of effort that I need to participate in this asset class is very, very limited. And because of the rest of the things this product offers, we should really go ahead and at least test it out to see how it adds value to our financial portfolio. And last and foremost is returns, because we believe that everything else comes first. Returns is basis your own risk appetite and risk profile. But the way we look at returns as a bond, as I mentioned, that it is higher risk than fixed deposits. Not government bonds, but corporate bonds will be higher risk than fixed deposits, lower risk than equity market. They will also give you higher return than fixed deposit. So typically today, what and how people invest money is that, if I say that I need to invest in 1 year or 18 months, I know I can't invest in equity market. So typically the individual investors, go back to fixed deposits. We'll make a 12-month, 18-month FD because I want that money back in that time frame. Here, you're getting another asset class where you can have that same kind of predictability, but you can earn a higher return. So an equity, a fixed deposit will give you 7-8%, let's say, return. Here you can invest in a bond which gives you 10-11%, and at the same time the same kind of certainty that in 18 months or in 12 months I'll get my money back. So it gives a better return to your portfolio. On a post-tax basis, at least it ensures that you're beating inflation. So fixed deposit, the biggest challenge with fixed deposit is that while it's a great asset class, the real return in a fixed deposit post-tax is actually not beating inflation most of the time, right? And at least by investing in bonds which give that additional 2-3%, it ensures that you're at least beating inflation on a post-tax basis. That means that there is some real return and your wealth is growing on a net basis or even after inflation adjustment. So hence you should look at returns, stability, predictability, ease of access, and these make it really powerful for someone to choose bond as an asset. Next, we want to understand that, what are the typical risks associated with bonds, because with every financial product, when you understand, what the benefits are, you should always understand the risks. Now, if you talk to a person who works in a bank at the bond desk, obviously the risks will be far more, there are 5 or 6 risks, but for individual investors, these are the two most important ones. So we wanted to keep it simple. So the two important risks that you want to know or you should know is first and foremost a default risk. So as I mentioned, in bonds, what happens is that there is a company or a government or a bank which is actually borrowing money from you. So the risk is that what if tomorrow this company or bank goes bankrupt, and when they go bankrupt, there will be a default on the interest or principal that you are. So and hence we say these are fixed income instruments, means that the returns are fixed, but they are not guaranteed, right? So they have this risk, what we call as default risk. You should also know that this default risk typically plays out. You have seen some bonds, people would be aware of bonds in the Indian ecosystem where defaults have happened. Now, you should understand that these defaults happen when the company goes completely bankrupt. So typically, there might be, some companies face delays, but defaults are limited. When there's a default that happens, typically the company has got bankrupt. Because the company has not got bankrupt, all the bonds that we do are secured in nature. So that means that the first cash flow that you get from the company belongs to the bondholders or the debt holders. So unless the company is going bankrupt, it is highly unlikely that there will be a default on the payment. Yes? Delays are also a risk, but that is not that is a risk of timeline, but there is no risk on getting that money back. Right? The risk of getting your principal or interest back is a default risk, which typically will happen if the company goes bankrupt. Second is liquidity risk. So typically in equity markets, we know that liquidity is very high. So if I want to sell a stock anytime, I can go into my demat account and sell. That is so I might not make a profit. I might have to sell it at a loss, but at least I know I'll get some cash flow. Today, because the market is still developing, there is a liquidity risk where if you want to get your complete principal and interest back within, let's say, after you made an investment before the maturity, you won't find a buyer in the secondary market, right? So, and hence we say that when you invest in a bond, you should plan your cash flow so that you match your requirement basis the money that the bond is giving you as repayment. So, if you know that it's a 12-month period or a 12-month bond that you have participated, you should know that your money is locked in for 12 months. And if I need money before that, I should not be then participating in this product. So you plan your finances, plan your cash flows so that you're marrying your investment or your cash flow requirement to what the particular bond is offering in which you're investing. Because there is a certain liquidity risk. As the market becomes more mature, liquidity risk will keep reducing. So as and when so if you ask us 2 years later, 5 years later, the liquidity risk will continue to reduce because with more participants, it means that you will always find a buyer for even a bond when you want to sell, right? So default risk is there, liquidity risk is there. You should understand both in detail, and we are happy to handle anyone who wants to understand these post the webinar as well.
So first, thank you,
Yeah.
Saurav, for explaining, I think, all the participants what the bond market is, what are the benefits of investing in bond, what the risks are involved in bond. But before I move into Giraffe, actually, I have a question in this last point which you mentioned about liquidity risk. Is our bonds like freely transferable like equity?
Yes.
If you find a buyer, can you sell it?
Yes, so bonds are freely transferable as equity. Vineet, actually, great question. So, if I want to sell my bond to Vineet and Vineet is a willing buyer, I can transfer it with a click of a button, right? So I can put a sell. So all the bonds are credited in your demat account. You can go to your demat account and put a sell order. I can then ask Vineet to put the corresponding buy order, or in a click of a button, this transaction can conclude in 2 minutes, right? So the process of selling, transferring is very, very seamless if you have a buyer. And again, as platforms like Giraffe, we are also helping people, access liquidity because, there's a large ecosystem that we deal with. But when you invest, you should know that this is not certain. But in most likelihoods and in a lot of cases, you will find liquidity at the time of your investment.
And also a particular type of bond are more liquid like GSEC and T-bills vis-a-vis,
Yes.
I would say, corporate, right?
Correct. So, if you see government securities, there are, as we mentioned, that mostly these are large-scale institutions that participate in these government securities, securities of large PSU companies, of companies which are government-owned like REC, PFC, etc. So when you try to, or state development loans, which are state government bonds. So when you look at liquidity in these, you'll always find a buyer because all institutions are large purchasers of these kind of bonds. So if you participate in these bonds, finding liquidity is that much simpler. And in fact, if you talk to, for example, Giraffe, we can bring liquidity for these kind of papers within 2-3 days time. It's very simple to arrange liquidity for these product categories.
Thank you again, Saurabh. Thank you
Yeah.
for explaining the bond market and the benefits of investing in bond.
Over
Now,
to
what I
you.
will be doing is that, I will be talking about what Giraffe does, how we are simplifying the process of investing in bond, what are the different types of bond, that we provide access to, and how all the participants and investor can come onto our platform and invest in a seamless manner. So basically, why Giraffe? Okay, so what is Giraffe? So basically, Giraffe, as Saurav mentioned, over last couple of years, what has happened is that earlier the bonds as a investment product was not accessible to a majority of the investors, and now platform like us, wherein we are providing a seamless experience via tech-led platform, wherein investors, like on the left hand side, you can see they can come to our platform, they can see all the deals that are listed on the platform, and these are not random deals that we list on the platform. These are highly curated deals wherein we do the risk assessment. I will talk more about it in the later slides. And once it is curated, once it is risk assessed, then only those deals are listed on the platform. And after participating in these sort of deals, the borrower or the counterparties, they get the capital basically. We underwrite all the deals that we do. Okay, it's not like we do matchmaking. All the deals are underwritten by us before even listing it on the platform. So Giraffe essentially is providing a technologically secure and convenient platform for all the investors. How do we do the credit risk assessment process? And as I mentioned, how do we curate deals? So let me give an example. Say, for example, Shriram Group, a corporate, wants to borrow, say, 50 crore rupees. Okay. So we have an investment team who will talk to Shriram Group. They will gather all the information, which is the first step. They will analyze all the information that they have gathered. They will have multiple Q&A sessions with the company, with the finance team, with the CFO, the promoter, etc. Then a detailed due diligence is done. They will do the deal structuring, finalize the terms of the agreement. What is the security that we are getting? What is the documents that needs to be executed? What are the legal covenants that we need to put? Once the deal is structured, it gets approved by our internal IC. The IC is again led by a team of 5 to 6 people who are all from the industry and have done investment for over a decade individually. Then we allocate our capital. Okay, so basically we underwrite the entire deal. We will put that 50 crore from our own balance sheet, and we will underwrite the deal. And once it is underwritten, fully baked, all documentation in place, all securities are created, only then the opportunities are listed on our platform. And once it is listed on our platform, any investor who logs into our platform can then see the deal and then decide to participate. While deciding to participate as well, we have all the informations about the particular deal being provided onto the platform. In case you have further queries, you can reach out to your respective RMs. We have live chatbots, which are manned by our RMs. You can ask your queries there. So once you are convinced that this is a good opportunity which fits your investment thesis or it fits your risk profile, you can go ahead and do the investment. Just to give you a data set, less than 10% of the opportunities that we see is being approved by our internal system and processes. So in fact, what it means is that if you're talking to 10 companies, only one out of that 10 companies gets approved, which is passed by our internal credit process and then listed onto the platform. So hence it is highly curated and sort of a very exclusive offerings that you get in terms of corporate bond offerings that we have. So here, this slide, we are talking about what are the different types of bonds that individual investors can invest. The first is a treasury bill. So T-bill is basically a bond issued by Government of India. These are short-term in nature. It is as it is mentioned, it is issued by RBI with a sovereign guarantee. Sovereign guarantee, it means that the bond is guaranteed by Government of India. The tenor is generally less than 12 months. You have 90-day bond, you will have multiple tenor bond. All of them are generally less than 12 months. And the yield is between 6.5 to 7.5%. Now, this as an investment product is again very unique. Most of the participants here would have substantial amount being invested in FD, but they are not aware that a product where they can seamlessly invest. Just to tell you more about it, an FD even is only guaranteed by Government of India up to 5 lakh rupees. So suppose you are keeping say 50 lakh rupees FD in the bank, and say tomorrow the bank defaults or goes bankrupt, Government of India will only repay 5 lakhs out of those 50 lakhs. That is the cap on the guarantee given by Government of India. But if you have invested in T-bills, say 50 lakh rupees you have invested in T-bills, the government guarantees 100% of it. Okay, because it is a sovereign issued paper, and the yields that you get is similar to FD. So now again, this as a product is not a new product. This product is existing since decades, but it was never available for individual investors to participate. Most of the ultra HNIs, family offices, institutions, they invest a large, they invest in the tunes of thousands of crores on a daily basis. The second product are listed corporate debt bonds. So when I say corporate debt bonds, these are corporates from maybe a listed entity to maybe a SME, MSME as well. They can issue bonds to raise capital for themselves. The way they raise is that they provide some sort of a security, collateral, guarantees, etc. to raise that capital. Generally, the tenor of these bonds are 12 to 36 months, and the yield that you can expect is between 8 to 18%. The yield is directly linked to the size of the corporate, and the type of the company and the risks that we are undertaking in the deal. And hence you have a wide range of yield offerings in the corporate debt bond markets. Here what the investors can do is that they can diversify this. They should, if they say choose to invest 5 lakh rupees or 10 lakh rupees, they should diversify it across 5 to 7 different corporates and make a healthy basket from a yield perspective. Moving on, we also have government securities and SDL like T-bill. These are also issued by government of India or the state government. So like you will have bonds issued by UP government. You will have bonds issued by Andhra. So various states also they issue the bond, and also the government of India they also issue the bond. If it is more, if the tenor is more than 12 months, generally it comes under the government securities and SDLs. Here again, if you're planning to invest a long-term nature, so for example, if you want to do a 3-year FD, or you want to do a 5-year FD, then I would suggest is that it is better to buy a government security bill, a government security GSEC paper, rather than investing the entire money in FD, because again it is 100% government guaranteed and you are getting almost similar returns. The fourth product is SGBs or the sovereign gold bonds. Again, this as a product, thanks to RBI, the product has been gaining momentum from an investment perspective over the years. It's a great product again from investment perspective, vis-a-vis buying a physical gold, this digital gold or the SGB. You get, not only you get the appreciation of the gold from the appreciation in price, you also get a 2.5% return from the government of India. Again, this is a government of India security, which is again 100%, and it is again very, I would say, very liquid as well. So if you want to sell your SGB at any point of time, you have a decent market for that as well, and a good investment product from a portfolio perspective. The last product is basically SDIs. So SDI is basically a pool of bonds. So rather than buying one single bond of a particular corporate, you can buy a pool of bond of different corporates, or you can buy a pool of bond from a different from an income generating assets. So there are various ways in which SDIs can be done. SDI again is a very, very big market globally. Okay, if you look at developed economies, SDI is extremely big. You have different types of SDI. You will have a triple A SDI, double A SDI, A SDI, differently rated SDIs, and based on the rating and the pool, you will have different yield. As you can see in the bottom, it might range from 8% to 15%. So what this slide shows is that like you have different types of shares, you have different types of mutual funds like large cap, mid cap, small cap. Okay, similarly in the bond space you have different types of bond, whether it is issued by governments of India or the state government, whether it is issued by corporate, or whether it is a pool of bond. You can choose to invest across these products in the bond space as well and create a healthy portfolio which can give you inflation plus at least 3 to 4% kind of a return easily. So, as I spoke, this is our team. Saurav and I both are the co-founders of Jiraaf. Our team is led by, seasoned professionals. Most of them have worked in, great financial institutions across the world. They have done investments, in their entire career. They have structured products. They have negotiated deals, and this entire team with more than 100 years of work ex, we try and curate all these deals on the platform so that investors in today's world have access to highly curated, very unique, well structured, and good investment products for our participants and for our investors of the platform. This is the last slide for us. What this slide shows is that in the last 3 year itself, from 2020 to 2023, the number of retail participation in the bond market in India has grown 10 times. So, just 3 years back, only 50,000 people in India were participating. Retail participants were there for the bond market in India. And today, by 2023, it was almost 6 lakh people. By 2024, I'm assuming it would have crossed 10 lakh as well. But what it shows is that this product mainstream, the early adopters of the product will benefit from putting this as a part of their portfolio allocation. And like mutual fund started say in 2005 2006, and today everybody who is even starting earning a salary has started doing an SIP. Similarly, in next few years, bond will become a very very mainstream product, and it will become part of everyone's portfolio. So the early adopters, if the more you make a portfolio where a certain allocation is not done to bonds, it's a great start, and will help in the long run from a wealth creation perspective. So the way you can invest in Giraffe, it's a very, very simple process. It's a three-step process. You can just log into our platform. You can complete the KYC online. We are a SEBI registered platform having online bond platform license. You can select from all the opportunities and then complete the payment and receive the securities. The entire process can be completed in less than 5 to 10 minutes. In case you need any help or assistance, at any point of time, please feel free to reach out to us, and we will have someone from our team who can help you in the entire process and make the investment process seamless. Thank you everyone for coming and listening to us. Feel free to reach out to us in case you have more queries, and do check out our platform, and if feel free to reach out to us if you need any help in your investment process. Thank you again. Thank you, Saurav.